So for those of you that don't know me or haven't met me, my name is Angie Aki. I am the owner and founder of Ohana Investment Partners. And my goal is to bring passive real estate investing to as many people as possible. So one of the things I uncovered as I got into real estate and real estate investing was the fact that I could take my active income and passively invest in real estate. And it truly has been one of the most magical things for our family. It's been a great way to create wealth and something that I want to share with as many people as possible. So on the path to educating you and moving forward with passive real estate investing, I am hosting bi-weekly webinars. So they're every other Thursday. The next one will be May 5th. And we will do either 12:30 or 1. So if you have any feedback, let me know. But they are short, digestible tidbits of information on passive investing or multifamily or commercial. So just small digestible information so you can grow your knowledge base and so you can grow in your education. So when an opportunity comes up for passive real estate investing, you are ready and educated to know if that is an opportunity that meets your goals. And that's one of the things we talk about a lot, is making sure you have clearly defined goals for your passive real estate investing as well. So today, and we are recording, sorry. Today we're going to talk about 5 reasons real estate is the most effective and lucrative investment. So that being said, we will get started. So one of the biggest secrets that wealthy people tap into is the incredible power of real estate. And real estate has made so many multimillionaires, millionaires, and billionaires. And so that's something that we can tap into as well as regular people or normal people. Real estate has the ability to generate passive income and provide a clear path towards building wealth. So you can build generational wealth for your family. So again, we're going to talk about 5 reasons why real estate is the most effective and lucrative way to grow your wealth. The first one is cash flow. So one of the biggest benefits of investing in real estate is passive cash flow. When an asset is purchased and so imagine it's a multifamily or an apartment complex, right? And so you purchase that asset, then those rents come in every month and they're collected from tenants. The remaining income after property expenses are paid is your cash flow. So when evaluating a deal personally, I always look to see if it's cash flowing as is before any improvements. This helps me focus on cash flow. It also helps minimize risk. So this meets with my goals. And again, everything's going to go back to goals. So one of my goals is making sure that I'm investing in properties that are cash flowing from day one. That may not be one of your goals, and that's okay because it's going to be different for everyone. But clearly defining that is really important. Taking advantage of cash flow is really important because an asset should be able to support itself. So often when we are talking to lenders or looking at financing for a property, the lender is looking to make sure the asset can support itself. And it looks at DSCR. And one of the things we're going to talk about in the next webinar is some of the terminology that we use in commercial and multifamily. But in essence, it's making sure the property and the revenues coming in from the asset can cover any debt that is held for that property or that asset. So we want to make sure we're looking at cash flow, and cash flow is great, right? That's what provides mailbox money. And that's what we like to call mailbox money, right? So you're bringing in cash flow and all that is going to trickle down in an investment, depending on if you are, you're one of the GPs or the general partners, an LP or limited partner, if you're taking it down with a partner or you're doing a joint venture or a JV. So cash flow is king, very important. The second thing we're going to look at is leverage. Leverage is simply using other people's money, either the bank's money, lender's money, or investors' money for a profit. So a really basic example is if you think of a single family or a duplex, whatever it is, right? Let's say you're buying a rental property and you're buying a rental property that is $200,000. You decide you don't want to pay $200,000 in cash because you don't want to tie up that much money for a rental. That's a solid decision, right? But maybe you're putting $50,000 down and the bank is contributing the remaining 150. That's called leverage because the cash flow you're earning and the rents you're earning is based on the full $200,000 asset, not your portion that you put in. That's the magic of leverage. So if you're getting, let's just say you're getting $1,000 a month or $2,000 a month for that property, we'll use 1,000 for round numbers. You're not saying, okay, well, I get a quarter of that, so I only get 250 and I have to send 750 to the bank. You're getting that whole, you're leveraging that whole $200,000. Yes, you still have, right? You still have debt on the property, but you're leveraging that money that they provided as well. Equity. So as you receive monthly rent checks and those are coming in, you're using those to pay down the mortgage or the debt on the asset. And while you're doing this, your equity in the property increases. So you're looking at what your property is worth minus any liens or mortgages or debt on the property, right? And then what you have remaining is equity. So as those payments are coming down or in from tenants and you're paying down that mortgage, you're paying down that principal amount, your equity is increasing. So in this way, the rental property or your asset, right, if it is multifamily or commercial property, generates income to pay for itself because you bought for cash flow, right? So this goes back to cash flow of making sure the asset can support itself. So imagine buying a vacation home that could generate enough money to pay for itself. All right, you can, right? So that's when people look at short-term rentals or long-term rentals. I have a lot of colleagues that are looking at, hotels either here nationally or overseas and looking at hotels and hospitality and things like that. So you want to make sure your asset pays for itself and you're paying that debt down so that your equity is growing. The next thing we're going to look at is appreciation. So because real estate values tend to rise over time, your money is working for you and you're also getting appreciation. So if you're investing in multifamily deals, you can also take advantage of what we call forced appreciation. So this means that you're not waiting on the market to appreciate, right? So this is really different than single family or 2 to 4 units. So when we're talking about multifamily or commercial deals, it's 5+ units or commercial space, right? Retail space, office, hospitality, things like that. It means you're not waiting on the market. You are in the driver's seat as an owner or as a partner in the deal or for the asset because you have control over that. So forced appreciation simply means that you are getting a better NOI or net operating income because you are either increasing your revenues or you're decreasing your expenses. And what that does is that increases the value of your asset. And that's one of the things that I put out. If you're not receiving the newsletter, please let me know. We'll make sure that you get a copy of it. But one of the things I put in the most recent newsletter was an example of a small mobile home park a partner and I just closed on in March. And one of the things we did is we actually, we put in $500 worth of work into this mobile home. We had the tenants move out. So they were month to month, they were ready to go. So they moved out. We put $500, touch up paint, little things here and there. We increased the rent by $300 a month, right? Which is $3,600 over the year. And because we bought it at a 9 cap, and we're going to talk about this next webinar, right? What is a cap rate? But because we bought it at a 9 cap, that multiplied out the appreciation, right? So then we were able to force the appreciation or increase the value of our asset by $40,000 simply by increasing the rent $300 on one unit. So this is really powerful, especially in multifamily and commercial. Very, very powerful. So again, you're not just waiting on the market to appreciate, but you can force appreciation when you're looking at multifamily and commercial deals. So one of the many, many reasons I like multifamily commercial. So the fifth one is tax benefits. So when you invest in real estate, you get the benefits of depreciation, mortgage interest, deductions, as well as a whole host of other write-offs and a number of other related expenses, right? And so one of the things that I didn't realize as I was getting into passive real estate investing is the fact that you can take advantage of these tax benefits either as an operator or a passive investor. So when you're investing for multifamily and let's say you're looking at a syndication or a joint venture, whatever it is, and it's let's say is 3 to 5 year hold or whatever it is, and you're getting those tax benefits, that asset is getting those tax benefits, those assets pass down to the investors and the limited partners and the general partners or operators that are part of that asset. So you get to take advantage of those tax benefits as well. And that's all spelled out on your K1, which is a form you get, and you turn that into your accountant, and then they take care of all the magical things that happen there. But it is really important to know that you can take advantage of these simply by passively investing in real estate. And it's something that can really benefit you and your family at tax season, right, throughout the year. So investors often show losses on paper while actually making money through cash flow. The losses play a big part in helping offset other income. So this is a major reason real estate is so lucrative, one of the major reasons. And it's so important to make sure that you're taking full advantage of this, again, as an investor or an operator. So last webinar, we talked about active versus passive, right? And which one are you? So very, very simple recap. Active is when you're taking advantage of, taking care of day-to-day issues. You want to be involved in strategic decisions. You want to decide whether to evict tenants. You want to screen tenants. You want to handle any necessary repairs, any insurance claims. If something comes up and you need CapEx or capital expenditures and you need to put money into the property or the asset, you are willing and able to do that for maintenance, repair costs, things like that. Versus passive. Passive is a set it and forget it type of an investor model. You don't get calls from a property manager. You don't get calls about tenants, toilets, or termites. You don't have to do any paperwork other than the initial signing, right? As you're signing the PPM and you're signing the paperwork and sending in your wire. That's pretty much it. That is your active part of the investment if you're going passive. You do relinquish some of your control in the investment and you trust someone else to manage and execute the business plan for the asset on your behalf. So it is really important to make sure you have the education, right? And you have the knowledge to make sure it's a good deal, that you are comfortable with the team and their experience running that asset, because you are relinquishing your control and you are trusting them to best manage the asset and to make sure you get the returns that were promised to you. And you can be a combination of both. You don't have to be only active or passive. I like a really healthy combination of both. I'm an active investor. I'm a passive investor. Passive is totally my favorite. I love that. But you can absolutely be both. And you just have to figure out what balance is best for you and your season of life, and whether you're working another job or running a business, and what works best for you. There's no right answer, only the right answer for you. So that's it for today. A very simple and straightforward. If you're interested in becoming a passive investor and working with Ohana Investment Partners and you haven't signed up, you can sign up at ohanainvestmentpartners.com/invest. There's never any obligation. There is never any pressure. But what this will do is, as we get opportunities and offerings, it's going to help you so you can start sorting through. You can start seeing what these opportunities and offerings look like. You can start asking questions, and you can start really clearly defining your goals and knowing, okay, is this an investment that's right for me, or is this not, right?